How do prepaid expenses relate to prorated taxes at closing? Have you ever wondered how prepaid expenses connect with prorated taxes when closing on a home? Understanding this relationship can make a big difference in your real estate transaction. Let's break it down in simple terms. Prepaid expenses are payments made upfront at closing. These cover future costs related to the property, such as property taxes, homeowners insurance, and mortgage interest. When buyers close on a home, they often need to prepay a portion of these expenses. This ensures that funds are available when these bills come due after the closing date. For instance, lenders usually requiring buyers to set up an escrow account. This account is where a portion of property taxes and insurance premiums are held. The lender uses this account to pay those bills when they are due. This means buyers are paying in advance for costs they will incur while owning the home. Now, let's talk about prorated taxes. Prorated taxes are adjustments made to divide property tax costs between the buyer and seller. This division is based on how many days each party owns the home during the tax period. Property taxes are often assessed annually or semi-annually but are paid in arrears. This means the seller is responsible for taxes up to the closing date, while the buyer pays for the time after closing. At the closing table, the seller receives a credit for the prepaid taxes that cover the period after they no longer own the property. Meanwhile, the buyer pays their share of taxes for the remaining time in the current tax cycle. In practice, the buyer's prepaid expenses at closing often include the prorated portion of property taxes they will owe. This means buyers pay upfront for their share of taxes, which may be collected by the lender to hold in escrow. The seller, on the other hand, is credited for taxes they have already paid but will not owe for the time after they move out. For both home buyers and sellers, understanding how prepaid expenses relate to prorated taxes helps clarify the amounts on the closing statement. Buyers should expect to pay these prepaid expenses, including prorated taxes, to cover their upcoming tax liabilities. Sellers receive credits for taxes they have prepaid but do not owe for the time after they move out. This process ensures that both parties only pay their fair share of property taxes and related costs at closing.